Stock market crashes are frightening, emotional, and confusing, especially for new investors. But smart investors understand that crashes are not the end of wealth building, they are part of the journey. When markets fall sharply, panic spreads quickly, prices drop, and headlines predict disaster. Yet history shows that every major market crash has eventually been followed by recovery and growth. The first thing smart investors do during a stock market crash is stay calm and avoid emotional decisions. While many people panic sell their investments out of fear, markets move in cycles, and short-term fear should never override long-term strategy. Instead of reacting emotionally, experienced investors step back, review the fundamentals, and remind themselves why they invested in the first place. Another important action smart investors take is focusing on the long term rather than short-term market noise. They understand that wealth in the stock market is built over years and decades, not days or weeks. Temporary declines do not change the long-term value of strong companies or diversified portfolios. Smart investors also avoid constantly checking prices, because watching daily market movements increases anxiety and leads to impulsive decisions. Instead, they trust their plan and allow time to work in their favor. Diversification is another key strategy during market crashes. Investors who spread their money across different assets, industries, and regions are better protected from extreme losses than those who put all their money into one stock or sector. Market downturns often push high-quality companies to undervalued prices, creating buying opportunities for patient investors. Rather than trying to time the exact bottom, smart investors invest gradually through methods like dollar-cost averaging, which reduces risk and removes emotion from decision-making. They understand that no one can predict the lowest point of a crash consistently, so disciplined investing is safer than guessing. At the same time, smart investors protect their financial foundation by maintaining an emergency fund. They never invest money they may need in the short term, which allows them to stay invested during market downturns without stress. Another critical behavior of smart investors during crashes is reviewing risk tolerance. Market drops reveal how much risk an investor can truly handle. Instead of abandoning investing altogether, smart investors adjust their portfolios if needed to better match their comfort level while staying invested. They also avoid chasing quick recoveries or risky bets, because crashes often attract speculation and false hope. Education plays a major role as well. Smart investors use market downturns as learning opportunities, studying past crashes, understanding economic cycles, and improving their knowledge rather than reacting blindly to fear-driven news. Smart investors also ignore noise from social media and sensational headlines. During crashes, misinformation spreads rapidly, and emotional opinions can influence poor decisions. Instead, experienced investors rely on data, history, and long-term fundamentals. They understand that volatility is the price paid for higher long-term returns, and that avoiding the market during tough times often means missing the strongest recovery days. Many investors who sell during crashes fail to re-enter the market at the right time, permanently damaging their returns.